I'm Joanna Makris, and today we are here to talk about SPACs. Whether you love them or hate them, SPACs have clearly dominated retail trading action over the past 12 months. And here to talk to us about SPACs is Kris Tuttle, CEO of SPACvest, and hopefully we'll get a better sense of separating the winners from the losers. Welcome, Kris.
Oh, thanks, Joanna.
So let's dive in. How do you feel about SPACs? Are they the new dot-com bubble, or is this really the next wave of public vehicles for the future?
Well, they were a bit of a dot-com bubble for a while. There were some number of months where you could only describe it as free money because there are SPACs. They split into warrants and common, and I got involved with them just as we follow IPOs. And there was just a retail explosion in the SPAC world, and you could just, buy anything and make money. And things got, as you know, kind of crazy with some of the names, some of the more popular names like Virgin Galactic, DraftKings. These were sort of the catalyst names. Having said all that, that has kind of ended. Well, that's definitely ended. And if anything, the pendulum may have swung a little bit too far in the other direction, as just about everything that's live now is trading at or below cash trust value. So I think we've kind of come, somewhat full circle. In terms of the future, I think SPACs have proven that they're another tool in the toolbox for looking at your path as a company. Traditional IPO is still right for the Warby Parkers and these kind of companies. But some larger sort of industrial names, SPAC's still kind of an attractive way to potentially do it. And if there's a bit of hair on your story that may not appeal to retail, sometimes a SPAC is a way to kind of get past that. So I think like M&A, SPAC IPO they're here to stay, but hopefully it'll be a little bit more of a normal process without the kind of crazy volatility that we had during that sort of bubble phase.
Right, exactly. So critics of SPACs, talk about these companies have very loose disclosures, very liberal accounting, limited financials. What are some kind of cautionary, elements that you use when you look at SPACs, and how would you caution investors and guide them in this space?
Yeah, it's even worse. That's a polite way of saying it. I mean, we've worked with companies that, have just outright pretended like they never gave guidance in live Q&A. I've worked with CEOs who've said, I don't know what you're talking about. We never gave guidance. And then I would follow up with a question. Unfortunately, it's on Zoom where it's like, well, I have your slide deck here from February, and this is the guidance you gave. But of course, they won't address those questions anymore. So it's really bad. I mean, there are disclosure issues and outright lying in some of these cases. So there's a few things that you want to do. I mean, first of all, you probably need to do some of your own research on these names. I tend to go towards companies that have existing brands and businesses that I'm familiar with. So that's a good first step. They're also looking at the underwriter. Underwriters aren't perfect, but a Goldman or Morgan Stanley is a little bit more likely to, have done the work than, I don't want to pick on anybody, but, there's B. Riley, there's BTIG, there's Roth Capital, so there's tiers. But you should, and even quality companies, you should not be relying on these 2025 projections and ridiculous, we're relatively cheap compared to some, group of the highest multiple companies that can find in the market. So, unfortunately, it's like, as you pointed out at the beginning, this really has kind of become a stock picker's space. So doing your work, finding the right companies, management teams, and real businesses, that's the only way to really protect yourself.
Yeah. So what are some of the metrics that you look at in terms of financials or valuation? How do you differentiate, a good pick from a bad one?
Well, it definitely starts with the management team and the product. So that one name that we own a fair bit of is called Weed Maps. It's in the cannabis space. I'm not an avid cannabis investor by any stretch, but it's clearly a thing. I've known the company for a long time. It's a technology platform, like a Square or a Toast, point of sale, online. I don't want to go too far. It's not Shopify. But if you're in the cannabis business and you're dealing with a recreational market, you need all this compliance and point of sale software. So they have a real product with a real competitive moat, with a really good management team. And that's the starting point. It's not the cheapest stock in the world. If anything, it's priced pretty well, but this is a big potential market. So those are those are the absolute starting points in terms of the names that make it into our, we maintain a model and a real money portfolio.
Excellent. And, what are some of the names that you're liking right now?
I'll tell you some of the names that we have liked a lot, continue to buy. They include Weedmaps. There's a company called Matterport, which, if you're familiar with sort of the next generation of virtual reality, Matterport actually supplies the technology to capture the insides of all the buildings and all the rooms and all the mechanicals that go online and then are used to do a whole range of applications. So they've got some really leading edge technology. They've been signing contracts with real estate agencies and the governments. And it's kind of one of these, very futuristic, but strong technology, strong management, et cetera. It's all the same kind of things. We've also owned Sports Genius, which is a kind of sport tech, entertainment and betting brand, working with most of the big leagues and minor leagues. You might have seen Sports Radar go public today, regular way IPO. That's another great company in the space. A consumer brand name that people might remember is the old Playboy, which, I didn't love it initially, but it was very inexpensive. And of course, they have a brand, which even though it's kind of scorned here in the US, it's actually like in other geographies, particularly like Asia, it's still viewed as cool. But they're really shifting to be an e-commerce company. And, I think they have a lot of potential. So those are ones we have owned. There's two new ones that we just started buying that I think are pretty interesting. One is a name, you may remember this guy, but the company is called Rockley Photonics. And the founder is this guy, Andrew Rickman, who started Bookem way back when, like whatever, in the 80s or 90s, prior to the big photonics wave. Anyway, these guys have pivoted to produce what they're calling sort of the ultimate spectrometer chip. And, basically it's a vastly more powerful sort of solution than you can get with LEDs to do all kinds of biometric measurements. So, and sense everything from blood pressure to alcohol concentration to glucose, et cetera. They're working allegedly with, the Apples of the world on the next generations of the watch and those sort of things. It's a high risk situation that they won't be commercial for a while, but if it works, I suspect they probably get acquired before they go full commercial. I think it's an $8 stock. It's post SPAC now, RKLY. That's one I think has a lot of upside for people. And then another interesting sort of tech play is there's a handheld ultrasound company called Butterfly Networks. Ultrasound has been held back by these big machines. They've got a really powerful handheld device that pairs with your iPhone or Android phone. And it's opening up a huge market for that kind of price point, new applications, home care, all that kind of stuff. That's been just sitting around pretty much since de-SPACing. Maybe it's 12-ish, 13-ish dollars a share. So those are like two pretty new names that we've been adding to pretty aggressively.
Yeah. A lot of companies in the SPAC world are claimed to be technology disruptors in massive addressable markets, claiming, hockey stick kind of revenue ramps, right? And many of them are in the EV space, both on the car side and the charging side. I did want to ask you about Lucid Motors, which is one that's of tremendous retail interest, and your thoughts on that as potentially the next Tesla killer.
Well, Lucid is definitely, I would say, it's got the best EV story out there, the best management team, the most attractive sort of vehicle. Much to their credit, their vehicle is actually rolling now. People are driving it and saying great things about it. So they deserve some credit for that. In terms of, the Tesla killer gets a lot of clicks, I'm sure, for reporters, but the company is the first to tell you that they're not a Tesla killer at all. They are going for a tiny, like 0.5% share of the luxury car market. They are not, yes, they're going to have multiple models, but they're not a Tesla killer whatsoever. The question is, how well are they going to execute in terms of delivering cars at scale? I think they can sell every car they can ship. The question is, how many can they ship? The current valuation, I guess, is around 31 billion, which still seems high to me, given that they haven't started the commercial ramp yet. And half of their projected revenues, I think, in 2023 and into 2024 are even based on the Gravity SUV, which we haven't even seen yet. So it's definitely an interesting company. I'm puzzled by why they're launching so many models when they probably can sell every Air that they can make for the next 5 years, if it holds up as well at scale as people are seeing from the test drives. But it's ultimately it's a really niche product, so it's going to be like more like a Porsche or a Ferrari. Well, maybe Ferrari's a little too high end, but it's really going to be a niche positioning in terms of where the company lives and what part of the market they're going to get. Ultimately, they may get acquired by someone who has a hole in this area, but not a strong brand like a Kia or or a Hyundai or somebody that's got a robust business, and they're going to have their own EVs, but this would get them a different level of cachet in the EV space. So not terrible, but I'm neither long nor short it, nor would I be inclined to do either one of those at current prices.
Got it. And talking about kind of head scratching, puzzling valuations, the EV charging space also seems to be characterized by some pretty incredible numbers. And I'm very curious about your take on, the charge points, EV goes of the world, and what you think about that space in general.
Yeah, I've gone through all the, done all the interviews and shows with management, and I have never been able to get excited about the charging space. If you start to look at it, the low end chargers are essentially a glorified extension cord that they're selling online for $800 for people to put in their garages. That's already very competitive. There are 10 of them. There'll be 20, and they'll be $100 in a year. And at the high end, it's going to be very fragmented. I see utilities and other outfits doing most of the high-end DC charger installations that at least I've run across. And again, the long-term business model is what they're kind of ultimately a commodity. So I have never, as much as I've looked at them, been able to get enough interest to do any deeper research or care to really want to own any of them.
Yeah, got it. So, we talked about what's overvalued. Do you have any sleeper stocks that, no one knows about right now and that you're looking at that could be interesting?
Well, there's some, one is a very traditional name that we've owned for a while, but I think it's going to be a great stock. And part of the reason is it's kind of a ho-hummer. The company's called AirSale. ASLE is the symbol. I think it's around $13. Anyway, they're in the commercial aircraft sort of maintenance and supply business, which obviously got decimated in 2020. But it's roaring back. They've got like 30% EBITDA margins and climbing, strong growth. They might earn $1.20 this year with a stock at 13. So it's kind of a $20 stock in terms of how undervalued it is right now. And if some of their new products that are a little bit more tech take off next year, could be, a $30 or $40 stock, but it's fundamentally cheap at something like 10 times earnings. And there is like a very small, what I would describe maybe as a backdoor play in the SPAC world. A company I've known for a little while, it's actually close to where I live here in Kentucky, called American Resources Corp. AREC is the symbol. It's got like a $2 and some odd share price on it. But they are building a pretty big business around supplying high-grade coal products to the steel industry. But they've also got some processes to get rare earths out of the abandoned coal mines, which they plan to supply to the EV market. So it's a very interesting speculative story, but the SPAC angle is they launched their own SPAC. So they're the sponsors of a $100 million SPAC, which will do a combination at some point. And as the sponsor, shareholders of AREC get those shares. And so you've kind of got a double value sort of situation in this name with some, I think, a good team, high insider ownership. So, it's definitely sort of a something that'll probably move, counter to the market, hopefully. But it's a great little story that I don't believe anybody covers it or writes about it, or, that the company has much of a following right now.
Fantastic. Thank you so much, Kris, for joining us. Super helpful.
Thanks, Joanna. Anytime.